Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist of EarningsBeats.com, and I'm happy to join you on this Tuesday, November 17th. It is a really important week for us at EarningsBeats this week. We've got a couple of big events. I wanted to point that to you before I get started. Later today on Tuesday, 4:30 p.m. Eastern Standard Time, we're going to have a Max Pain webinar. We do these every month, the Tuesday before options expire. The monthly options expire every Friday, every third Friday of every month. And so we always do this Max Pain webinar the Tuesday before, talking about where the market might go as a result of outstanding interest in options, both on the call and put side. So we'll also go into some individual stocks that may benefit or that options could hurt. So if you want to be part of that, you can go to our homepage at EarningsBeats.com. Make sure you just click here, and you can join us. Also, we have a free newsletter. Earnings Beats Digest comes out Mondays, Wednesdays, and Fridays. Give us your name, email address, and hit that subscribe button. No credit card required, and you can unsubscribe at any time. And then finally, on Thursday, we'll be announcing the 10 equal-weighted stocks that go in each of our portfolios. And if you look down here at the bottom of your screen, you can see the performance of our portfolios versus the S&P 500. It's been outstanding. We're about to wrap up our 7th quarter in the last 8, where our model portfolio has beaten the S&P 500. That's 7 out of 8 quarters. Currently, we're up more than 5 percentage points with just a couple of days to go. And we are now just 2 days away from this model portfolio being in existence for 2 years. And right now, our since inception return is plus 155%. So we'd love to have you come over, check us out, join the service, join us for the Max Pain webinar tonight, and then Thursday night, what I like to call the draft, where we will be drafting the 10 stocks for each of our portfolios. We'd love to have you. All right, let's move on and look at these charts. The first one here, I'm a fairly short-term trader, but I do like to show this chart periodically. It's a long-term, big picture chart. I believe I showed this chart on this show, your Daily Five, back in, I want to say May or June. But I said back then that I thought that what we saw in the pandemic and the big drop in the S&P 500, that drop would look very similar to what we saw back in 1987 with the market crash, because this pullback, well, it was more than a pullback, but this cyclical bear market was being incurred in a secular bull market. So cyclical bear in a secular bull. And so long-term uptrend, short-term pain. And that's what we felt in the pandemic here in 2020. We have rallied right back out of it. We've set new highs. I believe we are in a 20-year, 20-year secular bull market period, very similar to what we had in the 1950s and 60s, very similar to what we had in the 80s and 90s. I think now we broke out in 2013, clearing the double top from 2000, 2008, or 2007. And I believe that started what is likely to be an 18 to 20-year secular bull market, which takes us into the 2030s. We continue to move higher. And so from a big long-term perspective, I think it's just very important to keep this chart in mind. Now, where should we be thinking about looking? There's a lot of rotation taking place. Just here over the past 2 weeks now, we've gotten 2 really big pieces of positive news regarding the COVID-19 vaccines, one from Pfizer, one from Moderna. And I believe the stock market is preparing for life after COVID. And that's good news for many of the stocks that were hit hard during 2020, including small cap stocks. This is a chart of small caps relative to the large caps, the IWM versus the spider. You can see since about the middle of 2018, we have been on this huge decline. And I think that the pandemic finally put in a bottom. I think this is the kitchen sink being thrown in on small cap stocks. No doubt they've been impacted heavily by COVID-19. But again, market now is starting to look ahead. It's starting to look beyond COVID-19. And you can see this relative strength that has been building in small cap stocks relative to the large cap that you find on the S&P 500. The relative PPO has turned positive now. We had not seen that since back in 2018. So that's a positive development. And I don't think we're going to have a whole lot of interference or resistance to the upside. We'll have pullbacks along the way on a relative basis, but I don't see any major resistance until we get up here to this line that I've drawn across. That was a major top here. We held on the bottom there. We held on a bottom here. And then when we broke down, things really accelerated in 2020. I think we're going to make our way back up there. I think that gives us a lot of potential outperformance in small caps as we look forward. Next up, I want to talk about transports and utilities. Looking at the relationship between these two areas of the market is extremely important. When the economy is expected to improve and grow, or when it's in the midst of doing so, money tends to rotate toward transports because transports do well when the economy is growing or expected to grow. Utilities, on the other hand, tend to do better when the market is very defensive and where the market is maybe preparing for a recession. And so when you look at the relationship here between transports and utilities, when this ratio is going up, I want you to take a look at what the S&P 500 does. Here in about 2.5 years, during this uptrend, the S&P 500 went up 47%. During this 1.5-year uptrend, the S&P 500 went up 36%. During this uptrend that we've seen now since April, transports have been outperforming utilities now since April. During this move, already 44% on the S&P 500. When we're downtrending in this ratio, meaning that utilities are outperforming, check out the flat S&P here, the flat S&P here, and really a lot of volatility last couple of years, this 2.5 year period, but mostly just sideways here, up, down, big up, big down, but over that period, we really don't go anywhere. So it's important to understand the correlation between this ratio and the S&P 500. Down here at the bottom panel, I show you this correlation, and you can see we are mostly in positive territory, meaning that when the transports are outperforming utilities, the S&P 500 goes higher. We are in the midst of this uptrend right now. I think this bodes well for the market as we go forward. My fourth chart is taking a look at what I call the pandemic index or pandemic laggards. This is a user-defined index that I created at StockCharts back in, I don't know, over the summer at some point. But I looked back and I did an index of 10 equal-weighted industry groups, the 10 worst performers back in March and April. So in this period, and I put them in an index, and I've been tracking them relative to the S&P 500. So in June, when we made the big run on the S&P 500, we saw some leadership from this group. But as the S&P 500 continued moving higher throughout the summer, as COVID cases grew, we saw this index of laggards drop on a relative basis. So you can see the S&P going to new highs, but the index going down on a relative basis. So not very good action. Since that time, since we've been consolidating, a lot of folks think, well, we're not really doing anything in the S&P 500. Well, you do start to see rotation, and especially over the last 2 or 3 weeks. As the S&P 500 has come back up to challenge that September high and move above it, notice that the last 2 or 3 weeks, this pandemic index has been growing. And especially here in the past week or two when we've come out with this good vaccine news. So I think the pandemic stocks, watch that June high. But if you get stocks moving up and taking out their June highs, areas like hotels already have done it. Transportation services already have done it, but there are other groups that have not. If they begin to take out those highs from June, I think we're going to see a lot more money rotating into these areas that have not benefited from, or haven't benefited as much from this rally that we've seen since April. So this is a chart to keep a very close eye on. And earlier I talked about the 10 stocks that go into each of our portfolios. I want to give you a look here at our model portfolio over the course of the last year. And you can see since March, we've had a huge run in the model portfolio versus the S&P 500. This is a relative chart. And if you look over the last year, here's a price performance chart. 52 weeks, last 52 weeks, our model portfolio is up 72%. The S&P 500 is up 15%. We're going to be announcing the stocks that go into our model portfolio and our other 3 portfolios on Thursday at 5 p.m. Eastern. We'd love to have you come over and check us out at EarningsBeats. Join We have a $7 30-day trial. It's fully refundable. So literally it's a net cost of $0 for 30 days, and you'll get all of the information that we share over these next 30 days at no cost. Pretty good action indeed. All right, it was a pleasure joining you today on your Daily 5. Please remember to go to earningsbeats.com, sign up for that fully refundable $7 30-day trial, and join me later today at 4:30 p.m. Eastern Time for our November Max Payne webinar. And then be sure to join me on Thursday, November 19th, when I announce the 10 equal weighted stocks in each of our 4 portfolios for the next 90 days. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.